we're growing concerned. And that's one reason we reduced our exposure by about 6 or 7%.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here at the end of the week for another weekly market recap, this time featuring my good friend, the portfolio manager, Mike Lebowitz. Lance Roberts has the week off. Mike, how you doing?
Doing great. How about you, Adam?
I'm doing good. I'm doing good. As you said right before we turned the camera on, this will probably be pretty quick. Not too much going on right now. Said obviously with a heavy tongue in cheek. So a lot has happened since last week's update with Lance. First and foremost is the outbreak of war between the U.S. and Israel against Iran. And it's having a lot of implications. Right now, the price of oil is spiking, I believe, to multi-year highs here. Um, Iran, in response to the attacks by the U.S. and Israel, has been threatening to choke off the Strait of Hormuz, and not much is going through there right now. The world's really beginning to panic about that in terms of flows of oil and other things through there. This morning, President Trump posted a Truth Social note basically saying there's no negotiation possible with Iran until they're willing to discuss unconditional surrender. I think that was the trigger for the latest jump in oil, at least as of the day that we're talking here, Mike. Stocks are down. They have been in a trading range, which Lance and I talked a bit about last week, pretty much since October of last year, Halloweenish or so. Stocks really hadn't been able to break out of the sideways trading range. Lance was looking at a lot of, technical levels and, saying, okay, look, if it goes above here, that'll be a breakout to the upside. If it goes below here, that'll be a breakout to the downside. I'm curious when we get to the TA here for today's talk, Michael, whether we're seeing any technical breakdowns that make you and Lance more nervous that this consolidation might end in a breakdown. Maybe it was just a topping process all along. Don't know if we're in that danger zone yet. But like I said, lots to talk about. Of course, we've got some really interesting new data out too around jobs and things like that. But let's start with the war. Um, as you guys at RIA who are managing capital and have to preserve client capital, what's your status right now? Are you still as invested as you've been? Are you starting to take more defensive measures?
So over the last few weeks, couple weeks, we brought our exposure. We were slightly overweight our benchmark. We brought it back down to regular weighting. Um, as I'm going to show you in a little bit with the charts, the market really continues to just trade in a trend. Uh, Part of the problem is that trend is kind of an arc-like shape.
Hmm.
You can draw a rectangle, and I'm going to do that, but there is an arc-like shape to it, and we're on the right side of that arc. So that is a little concerning. But thus far, we really haven't gotten any good technical signals to say start reducing, get out. At the same time, our portfolios are sitting near their all-time highs. On what's today, Friday, we closed out Wednesday at our record high. So our exposure to different sectors and diversification and the way we've kind of moved around value growth, large cap, small cap, with not just defensive in the finance way, but defense stocks, the Palantirs, RTXs, has really helped the portfolio uh, reduce the volatility and pretty much stay up at our highs. Um there's a lot of within the portfolios, a lot of winners, a lot of losers on a daily basis. But as you know, we always tell our clients to look at the bottom line. We build a portfolio to affect the bottom line. And what we're finding so far, fingers crossed, is that we are pretty well hedged. And that said, we have no problem reducing exposure when those technical signals trigger or, potentially other things happen.
Okay, so we'll get into this in a bit, but it sounds like those technical triggers at least, to the downside where it would force you to say, okay, look, we got to lighten up here. You haven't seen them yet, but it sounds like you're watching the tape closely. I want to thank you and your colleague there, Lance, for demonstrating what this was the vision when we started these weekly market recaps with you guys, of just giving viewers a very transparent view into how quality financial advisor manages money for clients in good times and bad. So obviously, this is one of those times where diversification, is really playing its role. Lance and I talk about what makes a really good capital manager is the willingness to be unsexy, right? To do the things that are kind of boring.
I don't think that's a compliment.
Well, at the end of the day, it is if you're getting the returns that you want to get. Lance was saying, coming into this year, hey, here's a whole bunch of reasons on why we're starting to increase our exposure in the portfolio, move a little bit away or take a little bit out of the hyperscalers and the AI trade that's been doing so great. And we're going to feed a little bit more some of these, sort of value beaten down parts of the market that have been unloved. And, in the time you're doing that, you don't get a lot of kudos for it, right? Because people are saying, wait a minute, this thing's been red hot. Why are you getting out of the red hot thing into these boring things? Well, for these exact reasons. And again, I just want to commend you guys for doing it, being willing to take the slings and arrows while you're doing it, but keeping this audience informed of what you're doing, because you're really showing how an experienced, framework-based, logical financial advisor, practices their craft.
Right. I remember we got an email from a client back in November, December. We got the email the day we added to Walmart. We had Walmart already and we added to it. And he goes, why do we own this dog? Walmart has been one of the most red hot stocks within the staples sector since pretty much the day we got that email. So, I guess to your point, owning Walmart isn't very sexy, but it gets the job done. The other thing I would say that really helps Lance and myself are the gray hairs. It's the 30, 35 years plus being involved in the markets and watching financial crises, geopolitical crises, all kinds of events that shake markets. And having lived through so many different types of things, you gain an appreciation to, for lack of a better word, to avoid what your gut's telling you and
Mhm.
focus on the data, focus on your technical analysis, your fundamental analysis, whatever your analysis is, and not let that feeling in your stomach or that voice in your head kind of get you out of positions or put you in positions depending on the different scenarios. So, I think we can attribute a lot to our systems, our processes, our mindset, but you need to give equal credit to the experience. I think it's critical in times like this. The last couple of years, that experience was nice, but not as valuable as it is today when there's a lot going on and it's very easy to get freaked out.
Yeah. And we talk about this all the time. For most investors, most retail investors, especially the DIY crowd, oftentimes your worst enemy is yourself, right? It's
Mhm.
your emotions getting you into problems you shouldn't get into. And that's why not only the experience you're talking about, but the framework, right? The having a framework that you can look at data and say, okay, look, no matter what my emotions are telling me, the framework that I've invested in and built over years from my experience is telling me to do X, and that's what I'm going to lean into. All right, so back to the topic of the war. Whenever there's something geopolitical going on, I'll take pains to ask Lance about it when I know what his answer is usually going to be, which is it's kind of a nothing burger to the markets at least. The markets usually are pricing in what's more likely to happen, or they've got some, they've priced in every scenario and it's been weighted by whatever probability the market forces give it. But generally, big geopolitical developments don't really change the market that much. Maybe they'll roil it for a day or two, but things will kind of equilibrate. Is that the case here this time? And I ask because this conflict is really impacting, or looking like it's going to impact the flow of oil around the world. And that is something that can have, a very demonstrative impact on the global economy.
Yeah. I mean, the problem with these events is they're very short term. All of the assets that we're purchasing are very long term. We're looking at streams of cash flows that are priced based on the next 5, 10 years. And we're
Mhm.
looking at an event that could be days, could be weeks, could be months, could be longer. Like we don't know. Um, so that's number one. Remember what you own, whether it's a bond, whether it's stocks, whether it's some other asset. They're long-term assets that that are not really impacted. How much is Nvidia or Apple or Clorox's earnings really going to get impacted because oil is high for 2 months? The answer is some companies, very little. In some, there will be an impact. But you have to kind of focus on the longer term, understanding what's going on. Oil's a tricky one, right? Because this geopolitical crisis revolves around oil, and Iran is a major producer, and B, they run the toll booth at the biggest waterway that really moves oil to the east and to Europe. So it's a very important chokehold that they potentially have on the market. So what does higher oil mean? Well, it does. There is it's not as strong a correlation to CPI as you would think. We actually just put that in our daily commentary. I think it was today, Fridays or maybe Thursdays. The R squared, looking at changes in oil to changes in CPI is only like 0.20. So there's a correlation, and if you plot it out, you can see the relationship, but it's not great. Second of all, how does higher oil prices impact the economy? Yes, CPI will raise because of oil, but if we spend more on gasoline and energy, we have less to spend on all the other stuff in our
Right.
life, going out to dinner, going to the movies, buying a car, whatever it may be. So there's a natural drag that's also going on prices. And that's why the relationship between one component of CPI, oil, to CPI as a whole is not as strong as you would think, given how important energy is to the economy and to, prices in general. Second thing is, what does the Fed tell you every time? Whenever they quote CPI or PCE or PPI, they quoted core. Core PCE did this. Core CPI did that. Core excludes food and energy. And they do that, and it's kind of crazy, right? Because that's all we spend our money on is food and energy. But they do it because there's so many external impacts or factors that drive those prices that are out of the Fed's control, right? Weather. Weather had a huge impact on natural gas prices. There's nothing the Fed can do to change the weather and get natural gas prices to quote unquote behave. Same thing with the Iran war or with crops or with cattle or with so many different other things. It's out of their control. So the Fed looks beyond kind of temporary rises in commodity prices in general. Second of all, let's go back to 2008. The Fed cut rates as the price of oil shot up from 80 to 150. In the first quarter of 2008, they cut rates 1 full% as oil was going over $100 a barrel. That's still, what, about $15 above where it is today, and it was on its way to almost 150. The Fed never raised rates despite oil getting up to 150. And then it kind of got us to September, October, and they had to deal with the financial crisis. Oil plummeted, rates plummeted, but I think it's what the Fed's telling you by that is that oil prices are they're important. I'm not going to say they won't tell you they're important, but it's something they're willing to overlook, especially when it's event driven and that event timeline is unknown and not likely to be as it could be a very long timeline, but the impact it'll have on oil could be very short.
All right, Michael. Look, I want to ask you a couple questions here about oil. So I'm going to bring up this chart, which is this chart of the price of oil. This is West Texas, and you can see that it's basically exploded higher since the outbreak of the war with Iran. It was at about $65 a barrel beforehand. Now it's pushing $90 a barrel. So this is the squeeze that we're talking about right now that the world is reacting to, the oil price shock. How much higher it goes, who knows? But let me contrast that with this chart here of the XLE, which really hasn't moved that much, certainly not in the way that the price of oil has since the outbreak of hostilities in Iran. So I got two questions for you. One is, why not? Why are we not yet seeing the oil and energy sector stocks respond to the big jump in oil right now? And then secondly, if you look at the price of the SLE here, back in Q4, I was talking with Lance and you, I believe, about how a lot of folks that I've been interviewing have becoming increasingly bullish on the oil and gas sector. And, certainly oil stocks, have really underperformed for a lot of years. And they were beginning to say, hey, we think this thing may actually start to turn. And you can see here at the start of 2026, the XLE really started to move. I'm just curious, is there any way here that the complex sort of sniffed out the likelihood of the US going to war in Iran? Or is this really just coincidental that the industry was just starting to turn and then everybody, including the industry itself, got surprised by this?
I think it turned with value, right? Why did regional banks do so well over the last 6 months? Why did, the market rotated from growth to value in November-ish of last year. Energy stocks are one of the deeper value sectors. They're kind of always known as value. And not surprisingly, they took off while the price of crude oil was languishing. And, we've written about this. I don't know if Lance talked to you about it, but the price of energy stocks had gotten well above where they should be given what's going on with the price of oil.
Yeah, he had been warning about that. Yeah.
Right. And so you get to this event and the market's like, you're already very extended in price. There's not much more. They've been trading better in the market, but your upside is when you get valuations, and that's another way of considering valuations. Valuations so extreme, so high, it's hard to get more upside. And that was one of our chief concerns going into this year, is that valuations are high and therefore the amount of upside is limited. And I think that's what we saw with energy. The other thing is, okay, let's buy Exxon. What are we looking at if we want to buy Exxon? I want to know what their earnings are going to be going out to 2030, 2035. Will they have a blip positive in earnings in 2026 because of this? Maybe. They hedge. They don't they don't just leave their earnings up to the whims of the oil markets. They hedge a good chunk of it. So a lot of these gains won't flow through to the bottom line because they're hedged. Second of all, you want to go back, let's look at Clorox in 2019 to 2021. Clorox was, Clorox is the most boring stock there is, very slow growth. That stock almost doubled during the pandemic because demand was literally off the shelves. You couldn't
Right.
buy
We were
Clorox.
bleaching everything. Yep.
Right, right. Even ingesting bleach, as our
As
president
some
told us to do.
suggested. Yeah.
Right, right. But bottom line is it helped their sales for a quarter or two, and the stock is now well below where it was at the eve of the pandemic. So, the point is that we're looking at streams of cash flows, and those cash flows are hedged against changes up and down in the price of oil. So the impact on this over any kind of scale earnings is going to be minimal, barring any kind of outlook or events that we just can't foresee that permanently raise the price of oil. I just don't see that today.
Okay.
So
I mean, that
so
explanation makes a lot of sense.
energy stocks came in very overvalued, and you basically had priced in, knowingly or unknowingly, what was happening.
Okay. All right. That actually makes total sense to me. All right. So anything else you want to say about the war and its potential impact on markets before we transition to the regular technical analysis, what's going on with the S&P?
Yeah, it's kind of an important behavior. I guess we'll throw it under the behavioral file. I don't know which file you put it under.
Mhm.
Markets know everything there is to know. Doesn't mean they don't get surprised by events, but everything there is to know is priced into markets at any time. So if you think that the war is going to be different, you just need to know that the market, or if you think, 3 weeks ago, you think that something's going to happen and the market is aware of that, it is priced in. Energy was priced in. So you have to think something differently than what the market is scared of to really think the market is going to fall a lot or rise a lot. And I think investors don't realize that a lot of news, what becomes news, is known by some people beforehand. And when that happens, the market prices in. Its price is already adjusted for what may happen, for the odds of what may happen. So I think as you're thinking about the worst case scenarios, the best case scenarios, they are all partially priced in. And as they come to fruition one way or another, the price will move accordingly. But there are people that are trading these markets that know more than you, and they're impacting the price. So, from a kind of broad point of view, it's important to understand that.
Okay. And so just to sort of make that actionable, what's your advice to people then?
That you have to be careful about these doomsday scenarios regarding the war. You have to be careful about a scenario that it's going to end in negotiations this afternoon and everything's going to be hunky-dory. You have to accept that the market is pricing in what has happened already. And if you have a forecast that's very different than the market, you potentially have an advantage, but it's a forecast. You don't know more than the market. So you have to, A, have a forecast that's different and be right. And if
Yeah.
you are, you want to put some money on that bet, that's fine, but realize you're going against the tide
Okay. And
current.
kind of what I hear you say is don't be too cute trying to predict what's going to happen geopolitically,
Well,
whether there's going to be a truce or how it's going to end up, whatever. More sort of trade the markets we have, rather than try to, try to out predict the people who know more than you in this situation.
trade the market you have. And when I say that no more than you, I'm not talking about financial people, guys that work at JP Morgan or Goldman Sachs. There are people that are politically hooked up, that are in Iran, that are in the Middle East, that are talking to Israel, that are talking to our government, that know what's going on. And they're talking to the biggest investors in the world. So people have a much better idea than you can ever get from CNN or Fox,
Yeah.
or whatever paper you read.
And that's kind of interesting, which is, look, I mean, the powerful are always, there's always going to be an information asymmetry, between the really big investors and everybody else. I think one can argue that asymmetry has maybe reduced a bit with the advent of all the digital information that's out there, and hopefully programs like this one that bring in really smart analysts to share their expertise with the average person, whereas 20 years ago, the average person really didn't get, much access to that. But when you have periods of intense disruption like now, the value of information asymmetry is even greater. And these are people that have contacts, and again, not just in the financial world, geopolitically, et cetera, who can kind of pay for that information. And there's a lot in a time like this where even our government is not sharing the full story with us in many ways because they can't, right? They don't want to show their hands to the world if they're trying to affect some sort of larger, grander campaign goals. But there are very rich people who are politically connected or otherwise who can get access to at least some of that information, which gives them a more substantial leg up than they normally have over the general market participant.
Exactly. So you said it best, trade the market you have. Um, I mean, that's just the advice. And it's, again, kind of don't let your gut or that voice in your head sway you to do things that are not, that are um, abrupt or, that kind of go against really what you should be doing. Stay your course, have rules, understand what your rules are, be vigilant, and if you break the rules, sell. Like Lance and I had a long discussion this morning. What does it take to start reducing exposure? And we didn't talk about, well, if Iran does this or Israel or the US does that or the Fed. We talked about technical levels, lines in the sand, technical events occurring. Um, so have that conversation with yourself. If it helps you, write it down on paper and put that sticky on your computer and watch it, follow it, and live to your rules. You know, don't when you get there and you get a rule that's been broken, say, but something positive is going to happen this weekend. I'm better off not listening to my rules. So
Mhm.
that's kind of the advice I would give.
All right, well, that's a great segue to the next section here of looking at the S&P and looking at the technicals. Um, Michael, I asked Lance this last week exactly. Hey, what are the things you and Michael are going to need to see to conclude that it's not a consolidation? The past bunch of months haven't been a consolidation that's about to spring higher. That instead, oh, it's been a topping out process that's now starting to roll over. So I'd love to hear what the outcome of your discussion this morning was with Lance about what specifically would you look for to say, okay, we got to start lightening up.
Okay. So I put together a beautiful presentation for you, and
Thank you.
I'm going to start with bonds. And I'm going to end up with stocks.
Okay,
And I actually want to talk a little bit about value kind of once we get through some of the technicals as well.
sure.
Um, Let me share my screen. So let's just start with bonds because I know you're going to ask me eventually. So let's talk about what's going on with bonds. Bonds were trading well. The 10-year bond got below 4% right before Iran hit. So right now, what you're seeing are 30-year bond futures. It's a proxy for bond prices, not yields, prices.
Yeah. So as
And
yields go up, the price goes down.
and vice versa.
Yeah.
Right. So you can see that the 30-year bond has gone from about 119 to 116-ish, about 3 or 4 points. Um, Yields have risen, right? The 10 years around what, 415-ish, I think.
Hmm.
It was slightly below 4 before this started. So
And Michael,
bonds are
that's a little
strong.
contrary to people's expectations, right? Oh, there's chaos in the world. Capital is going to seek safety and it's going to go into treasuries, but that's not happening this time, right?
Well, the problem with this war is that the market perceives higher oil prices as inflationary, which is bad for bonds. And it knows this isn't perception or forecast that we now have higher deficits because of this action. How much, how long, we don't know. But what was already a troubling deficit situation by necessarily has gotten worse. And bonds, I think, are reflecting more of that than the flight to quality.
Hmm.
Um, Even today, we got the employment number was a very weak number, and bonds are slightly higher in yield. So that tells me that the market is looking at Iran and the negative inflationary deficit implications than the economy, uh, which is that's very helpful to know in this market what's driving, because you can kind of use bonds as a proxy for other markets. Well, here's what the bond market's thinking. So some of that same thought process is working through stocks or gold or the dollar or whatever other asset you're looking at.
Hmm.
But what I want to show here is that you can see these two light blue lines. We've been trading in a channel. I mean, you're going to see it in the stock graphs too. We've been trading in a channel, in this point, about a 6 point channel since about September. And really, they've been going sideways since more or less the beginning of 2025, kind of up and down. This black line shows there is a positive upward sloping trend line that the trend generally has been towards lower yields. It's just been kind of whipping around. Hasn't been volatile, but it hasn't been just a nice steady line upwards either. The
Right.
yellow
And
line is
like
kind of
stocks
the mid,
since October, pretty much range bound.
very much. I mean, even if you go back to March of 25, you got the little spike around the Liberation Day, but other than that, it's been in a similar range. Um, So, looking at it technically, we're coming up on the 200-day moving average. It's sitting right on top of it. We got this lower trend line that should support it. But we're in a period of consolidation, and the typically consolidations end up with a breaking out or breaking down. So, like everything else, that's what we're looking at for bonds. Its RSI is pretty low. It's getting oversold, not grossly oversold, and its MACD just went on a sell signal. So some of this downward pressure in bond prices or upward pressure in yields may continue. Now, it may just be time. We just stay where we just kind of slowly move around where we're at now, let the indicators become a little more bullish, then we rally, or there's something really going on here and bond yields start taking off. But these are kind of the technical gauges we're looking at here. The 200-day moving average hasn't been a great support resistance, but we would like to see it stay up, within a point or so of the line. It's not a hard and fast rule, the number itself. And we don't want to see it breaking lower lows, which is, call it 114. So another 2 points below where we're at.
Hmm.
Um, on the upside, if it can get above that light blue line, 120-ish, we can, make a case that yields are going lower. So some of this is just how does the bond market interpret what's going on with Iran and in conjunction with the recent employment data, with CPI coming out on I think it's Wednesday. And I'm going to diverge a little bit here, but bonds are highly correlated to inflation. So right now you got the oil inflation narrative seeping in. But we've been talking for a few months about Trueflation, which has shown prices plummeting. Their
Hmm.
inflation gauge is below 1%, and their inflation gauge has a very high correlation with CPI. So the question in our mind is not whether CPI is going up 0.8%, because it's not in the next 2 months. But what is Trueflation picking? Why is Trueflation picking up such a sharp decline in prices? And will that flow through to CPI in time? Because we know CPI lags Trueflation. So this CPI report is kind of our first look at this will be for February. Trueflation started dropping almost on January 1st. So we may get a hint of it in this report. If not, the next report will show it or it doesn't show it, and Trueflation is just off. But the two have been so highly correlated, that is just something to keep an eye on when you're weighing what could push this out of its range, upward or downward.
Okay. So
Uh, so
couple quick questions here for you. One, it seems like what you're saying here is in addition to the price action we've had, it seems the current interpretation of the bond market is, hey, there's going to be at least near-term inflationary repercussions from the war, the increase in the price of oil, et cetera. Therefore, it wouldn't shock you if bond uh, prices continued downwards a bit from here. But over the past year or so, probably longer, but definitely in the past year, you and Lance have said, hey, our general analysis leads us to believe that, over the course of the next year or so, um, inflation will continue to disinflate and bond prices will rise as yields come down as a result of that. Is that still your default assumption here, or is the more recent math changing your opinion?
No, I think inflation's heading back to 2% or even lower.
Okay.
I think the change, what's happened in bonds the last few days is less about the inflationary aspect and more about the deficit aspect. And that's we've talked about before. That's the term premium fear, is that deficits keep rising and the bond market just has to deal with this supply of bonds in the market. Investors then demand higher yields and yields go higher. So I think the market is more concerned about the cost of war in addition to all the other spending. And that's why, bonds are trading lower today despite employment because there's really all of a sudden what went from looking like a 1 week war is looking like a war that's going to be extended. How long? We don't know. So I think when you think about what's going on in bonds, think more deficit than inflation.
Okay.
But right now, and look, this can all change. I think of this as a speed bump uh, on the way to higher bond prices, lower bond yields, and inflation working its way to two
Okay.
or below.
Yeah, and folks, we'll be checking in on this on a regular basis with Mike and Lance. So, if that indeed is what happened, or if something else happens, we'll be giving you real-time updates along the way.
So so while we're talking about bonds, what's been in the news has really been private credit. That's been a kind of bigger topic. So, one of the things that we know from history is credit spreads tend to be a good leading indicator of the financial markets.
Hmm.
And when we talk about credit spreads, we're talking about corporate bonds. Private credit are loans that were made to smaller companies and they're having issues, delinquencies, defaults, some fraud. We've seen it in Citadel and Blue Owl. There have been MFS defaulted about a week ago. Uh, there were two auto companies, October, November last year, that defaulted.
Nice.
So we
White collar
saw
first brands. Yeah.
BlackRock, right? BlackRock put a gate on their private equity funds yesterday or today. They're only allowing these private credit investors to take out 5% of what they own. Apparently, the demand is for 9 or 10%. So we're seeing gates put on these private credit funds. So it's problematic. But the question is, from us is we're not overly concerned until this starts hitting the corporate credit market. So what I actually have here is a little treat, I guess. This is our new Simplivisor. This is something we're still working on. It's not out there for the public, but we're redoing the face. We're adding some enhancements. We're putting an AI twist on it as well. So I wanted to share a couple screens that are done that help us tell the story we're trying to tell. Um, so what we have here on the left side, or we break it down, credit spread. So let me start over. What does a corporate bond yield? Say a 5-year triple B corporate bond, what does that yield? And what does a 5-year treasury bond yield? That difference is the spread. And the wider the spread, the more risk the market is pricing in. The tighter, the more complacency the market's pricing in. So we can just kind of focus on this triple B line. Right now, you get paid 103 basis points more than a treasury to buy a triple B corporate. This is an index, so every bond's a little different, but the index is about 1% more over treasuries. So that what does that mean? That doesn't mean much, but we need to go back and look at history. And history tells us that over the last 20 years, that's in the lowest 3 percentile. It's basically at all-time lows. It's very tight, as you say, in the bond market. But as we look over the last 3 months and even the last year, it's in the upper half. So spreads are widening. They're not as tight as they were. You can see as you go down to like single C and B, these are junk bonds. They are basically around the highest they've been in the last year, give or take a little. Um, Down at the bottom, we have triple B graphs, and we separate them out, both short term and longer term. And the one on the left is our short term graph. You can see they've been picking up the spread, but it's still not that much, and it's really only back to average um, over the last year. And if you really see this on the 10-year graph, if you look hard enough, I guess you can see it increasing, but you really have to squint your eyes to see it. So the point is, there's a little short-term stress in the credit markets, but it's nothing, nothing like what we're seeing in private credit. That said, these markets can move really quickly. So what we're talking about today, by next Wednesday, could be a very different story. So this is one of those screens I look at every day just to keep an eye on to make sure that kind of that canary in the financial market coal mine is still standing up. So I think as long as private credit becomes an issue with war going on, with the economy a little bit unstable, this bears keeping an eye on.
Okay. So I've been asking Lance about the private credit risk, over the past couple of months as we've seen more and more headlines about it. And he's basically said sort of what you said, which is, hey, I could get worried about it. There's a lot of things I could tell myself to be worried about it, but I'm not going to start to get worried about it until I start seeing visible stress in the credit markets, specifically looking at these credit spreads. Um, so kind of what I hear from you, Michael, is you're worried enough about it that you're watching this thing on a daily basis, but right now it's not telling you that there's a substantial level of stress that something important is breaking yet. Am I getting the right
Correct.
message?
Correct. Um, and there's another way you can look, and I just noticed this, but my screen got cut off at the bottom. But what we have at the bottom is an analysis of LQD, which is the investment grade ETF, and junk, which is the high yield ETF. So, another way to look at it is to watch the prices of those two every day. And if we're getting into a more concerning scenario, JNK should be underperforming LQD. And that has been happening to some degree. So that's another way to keep an eye on the situation. And you can compare LQD to IEI, which is a treasury equivalent. And looking at those three, see how they're moving. And if you start to see J and K grossly underperforming LQD and LQD underperforming IEI, that's a sign that there's something going on, and you'll see it in these spreads as well.
Okay.
So,
So just as I asked you to kind of, prognosticate what might happen with bond yields from here, um, without the benefit of future data yet, how worried are you personally about the private equity risk to the markets, about private equity, as Lance and I have talked about many times, it's opaque, it's unregulated. What is your level of concern that we're going to find a lot more cockroaches as time goes on, to borrow Jamie Dimon's term?
so it's a little reminiscent of subprime. The question really is not how bad is the private credit market, and it wasn't really how bad is the subprime market. It's how much leverage and how much of that leverage was directly or indirectly on the major bank balance sheets. And I think that the answer is a decent amount less than the last time. So the impact to the true liquidity providers is hopefully a lot less. And whatever happens in private credit can happen without basically destroying the whole financial system. But if you can keep an eye on it by looking at like the stock price of Blue Owl and some of their competitors, but also keep an eye on the banks, the regional banks and the major banks, and see if they really start trading lower, because that will trigger risk in the corporate bond markets as well. So, again, let's just watch and see and look for signs. The key is to know, the key, I think, really in all of this that we've been talking about is to know what markets to look for and know exactly what you're looking at within all those markets.
Okay. All right. Well, look, I'll let you keep chopping your way here down to the stock stuff.
We'll
Okay,
get
this is
there.
perfect. I was literally just going to say, is somewhere in these charts, are you going to talk about the dollar? Here you go.
Here's the dollar. The dollar has been one of the beneficiaries of this recent incident in Iran. But you can see the dollar's been rising since kind of late January.
Hmm.
Like every other graph, Adam, we got a nice blue rectangle, right? It's been range bound since June of 2025. So how's the dollar going to break out? The dollar has been the weak dollar and the weak dollar narrative, because the dollar really hasn't been weak now for almost a year. The narrative about dollar debasement and dollar weakness has been what has partially driven gold and silver and foreign markets, emerging markets, developed markets. So, I think everyone, it's funny. All the financial headlines about Iran are kind of focused on oil. I don't see many on the dollar. The dollar may be more consequential to the economy, to the financial markets than oil. And I don't see a lot written about that. Um, our daily market commentary on Monday actually leads off with that and explains why. But bottom line is everyone in the world uses the dollar. And now all of a sudden, borrowing in dollars for all these foreign countries has become more expensive by 2 or 3%. It increases their borrowing costs. Um, all these financial assets that look good with the weaker dollar don't look as good to domestic U.S. investors because the
Hmm.
dollar's appreciating. Multinational corporations that are transacting globally tend to be impacted negatively by a stronger dollar. So again, it's another thing. How's it going to break out? Or are we just going to stay range bound here? Um, and you may not like this graph, but it shows the correlation, the recent correlation of gold, silver, and the dollar. Soon as the dollar, almost to the day, when the dollar started rallying, that's when gold and silver kind of struggled. Um, Not surprisingly, because you know the gold and silver trade as a function of the dollar. Um, so that's, you know, if you're in precious metals, that's something else to watch. The dollar, it's both the dollar appreciating the impact it has, but it also impacts that narrative of dollar debasement. How can a dollar be appreciating if it's being debased?
Hmm.
And we've talked ad nauseum about debasement, so we won't go there today, but it kind of flies in the face of the story that the market has been telling, which negatively impacts the precious metal sector.
Let me just repeat what I've done so far. Um, Looking forward from here, when you showed us the 9-month channel that the dollar's been trading within, it's beginning to approach the upward part of the channel. What do you think is more likely? A breakout to the upside or just the dollar reverses and starts heading down to the other lower part of the channel?
Some of this depends, you know, to be fair, this is where my cursor is right around here is where, about Iran started.
Yeah.
So some of this is Iran. Uh,
Meaning things quiet down there, we may lose some of that premium.
yeah. So you have to be careful not to extrapolate the last 5 days for the next 3 months. Um, I probably would have said that we stay range bound, but we do. One of the risks that we've pointed out for a while now is dollar appreciation. That means that the dollar gets out the north side of that rectangle.
Hmm.
So, I think my base case is that we trend towards the upper part of that triangle, my concern for financial markets in general is that we break higher. Um, what would cause that? It may just be a weaker global economy. Um, believe it or not, the Fed cutting rates could cause the dollar to appreciate. So, keep an eye on the dollar, not just if you're gold and silver investors, but all investors, because that has been the backbone also for foreign and developed and emerging markets, some other sectors, commodity sectors as well. And again, it has a big impact on corporate, foreign, multinational type corporate earnings.
Hmm.
Um, so now we're going to move on to the stock market. And this is I'm going to zoom in on this in the next graph, but this graph shows you kind of that topping curvature that's been going on that we've been getting concerned about.
All right, and
Once
Michael, it
again,
looks like the screenshot here is actually missing what this is. Is this the S&P?
I'm sorry, this is the S&P. You're right, it is cut off a little bit, but I'll explain everything here.
Okay.
So it's the S&P 500. One thing I know this is very crowded, and I partially have it crowded for a reason, but I'll get to that in a second. But when you look at the S&P 500, I'm going to skip ahead for 1 second. Here's the S&P 500 since late December, this box. Can you tell me where, if I just said somewhere, if we go back to January 1st and we're sitting down, I say somewhere over the next 3 months, there's going to be this thing in Iran, and I tell you what it's going to be. And by the way, here's a graph of the S&P 500 for the next 3 months. Tell me where the thing in Iran happened. I can't look at that graph and tell you where it happened. My gut would tell me, just looking at this, it happened in early February or mid-February. There's nothing here that tells me that there was an issue with Iran, right? I know it sounds crazy because the market seems to be so volatile, but it's really hasn't broken out of its behavior. Its behavior really hasn't changed over the last 2 or 3 months. We have lower highs. That's not good. We're kind of drifting lower. I get all that. But if you just look at the size of these daily candles, the color of them, is there anything here that tells you that if you didn't know any better, that something pretty big geopolitically was occurring?
Yeah, I guess if you can see the green candle there that drops below the trading range in the beginning of
Right.
March, maybe if that
Yep.
were a red candle, you could make that point, but the fact that it's green, I'm guessing, sort of kind of negates that.
I mean, yeah, yeah. And again, we're trading, again, the market, I'm going to go back. The market is starting to arc. That's not good. We see this resistance line that's downward sloping. That's not good. But there's nothing in this graph that tells me the last 5 days is that different. And
Right,
I,
that
I
the
think
market
that's worth,
totally changed. Yeah.
it's crazy because if I would have not looked at a graph all week and then looked at one today, it's not what I would have expected.
Hmm.
Um, so starting at the top, the MACD continues to be a, dare I say, irrelevant. It's just been drifting lower with the MACD and its signal just going back and forth, not really giving us any kind of signals whatsoever. Like here, we got a great signal. And when there's separation between the two lines, you get good signals. When it's doing this, you really get nothing. The RSI is at 40. It's starting to get a little oversold. Can certainly go lower, but it's just that too, just drifting lower. And this bottom line is what's called the average true range. And this is for the last 14 days. And it basically subtracts the high and the low from each day and gives you an average. So the high point of each day and the low point. And it's it's first of all it's low, but it hasn't really picked up. Again, back to my original point, it hasn't picked up appreciably, not like you typically see during volatile markets.
Hmm.
So, one takeaway is that I think what we think about the markets, myself included, is probably a little more volatility than what we see. Um, Now, when you dig into this graph, you can see one reason it looks so jumbled is because all these moving averages, the 20, 50, and 100-day moving averages are all right here. They're all next to each other. All the kind of support or resistance. When we are today, we're below the 100-day moving average. That is one of our lines in the sand. Um,
Can,
and
can you go to the next slide as you're talking about that,
yeah,
the
I think
close up?
this, yeah. So this gets a little easier.
Yeah.
You can
And
see the
just
20,
talk if you can about that. Yeah, the crossover of the 20 and the 50.
right. So we have a 20, 50-day crossover. That's not good, but it's a sh relatively short-term moving averages. So you have to be careful paying too much attention to that. And we got the 100-day, which we're trading below today. We'll see how we close. And we closed it below it 2 days ago, and we've dipped below it on a couple occasions. But that is a line in the sand. And then, we don't want to keep setting lower lows. So we have this low all the way down here at 6,700. That's another 100 plus points away. And then at the end of the day, what we have is the 200-day moving average sneaking into our picture at, close to 6,600. That's an important one. So, we're growing concerned. And that's one reason we reduced our exposure by about 6 or 7% over the last month because we've been seeing these patterns develop. Uh, and so when you say, okay, what's going to trigger us to reduce exposure? We got our close eye on the 100-day moving average, the black line. We're looking at these lows, which are not that much. They're another 40, 50 points where probably about where we're trading now. We're right around this line. Um, the 20-day is probably going to go through the 100-day moving average. The 50 is not going to go through the 100 anytime soon. And we got the 200-day moving averages. So those are some of our lines in the sand. Uh, Conversely, if we get some good news, if the price of oil drops $10 this afternoon or next week, we'd like to see get above these moving averages, break out this downward trend, and then ultimately start hitting higher highs. Um, so that's kind of our roadmap for the,
All right.
I guess, week, 2 weeks, few weeks ahead.
So, Michael, I know you're kind of reacting to what you see in real time here, but like in your conversations with Lance, is there anything right now that's on your short-term roadmap that if this happens, we will lighten up? Like, for example, if there are 3 days that now close below the 100 daily moving average, would that make you guys say, okay, we want to reduce a little bit of exposure here?
Yeah, possibly. Possibly. The tougher question for us is how do we do it? So there's been a distinct, and we'll get into this in a little bit, a distinct uh, difference between, a massive rotation, which, we've talked about. I know you and Lance have talked about it, between growth and value, between large cap and small cap. So one of the things we've been finding is, again, that there are days where half our portfolio, the stocks are up, half the stocks are up 1% or more, and at the same time, half of them are down 1% or more. So, and those stocks, it's not always the same stocks. So what do you sell? That, you want to keep this diversification, but you want to reduce your exposure. So we could sell growth and value. We probably would sell more value. We've been selling value on the margin. We may want to sell more value because it's grossly overdone here.
I was going to ask
Or-
about that. Yeah, exactly. Because
And,
value,
and,
Lance has been
and we'll
saying
get
some of
into
these
that.
value stocks you can't really call value anymore, right? Given their PEs.
You're leading me right along the way.
Oh, good.
Or we could just add a short position. We could buy the SHETF and just say, you know what? We kind of like the portfolio, but let's just add a little insurance.
Hmm.
So we could do it any number of ways. Um, so, back up here and here, I kind of was stressing to you that the market is relatively calm. If you didn't know what was going on behind the market, you'd say the market, and I actually wrote an article about this a week or two ago, the the not the implied volatility in the options market, but the actual realized volatility has been very low. But beneath that calm, serene surface, there has been some incredible volatility in rotations, moving back and forth between different sectors, different factors. So what I have here is what this does. This is from SimpleVisor. It looks back at the excess performance. So, for instance, how did energy do versus the S&P over the last 75 days? And then it goes back in 75-day increments before that. How was it the 75 days before that and the 75 days before that 75-day period? So just look at some of these differences here. So I got to move my computer a little, but energy, and I'm going to actually leave off energy because some of that is impacted by Iran, but
Yeah.
materials up and transports up 70%, while financials and technology down 4 or 5% versus the market. Those are big differences. Industrials, consumer staples up 12%. And then you go back to the 75 days before that. Look at some of these. Look, staples were down 12%. Healthcare and technology were up versus the market. So we've had, there's a fancy way of saying we've had a big rotation. Flipping over to our new simple visor, I'm looking at year to date. This is a grid I look at every day. It tells me I look at it usually on a 1 day basis. So what's the market doing today? But year to date, growth stocks are down a large cap growth is down 3.59%. Value is up 5.65%. All the small mid cap, even growth and value, are all up on the year. So, you can kind of look at this in a nutshell and see what's going on. And it's basically that the mega cap stocks, the Magnificent Seven, that were the greatest things ever, are falling out of favor, right? And people are buying value. And we'll talk about that in a second. What's value and what's not value. Well, where am I? And then I just also want to show you down here. So again, I'm year to date, and you can see how some of the sectors have been, the divergences in performance has been crazy. And this is why our diversification in our portfolio really helps, is because we have things going down, we have things going up. But it's allowed us to beat our benchmark, beat the market for the year by slowly shifting between what's working and what's not working. So with that, can we talk about what's value and what's not value, Adam?
Sure. Yeah.
Okay, so here's what's funny. And let's just use Nvidia and Walmart, right? It's no secret the market's been selling the Nvidias of the world and buying the Walmarts of the world for the last 3 or 4 months, right? And in doing that, what they'll tell you is they're selling growth and they're buying value. But what is value? So this is from FinViz, great graph. It's a heat map of the price to earnings ratios of the S&P 500 companies. The bigger the box, the bigger the market cap. So it's market cap sized, I guess you would say. The brighter the red, the higher the price to earnings. Green is more value oriented. So, and they're all sorted by their sectors, technology. And so we're going to focus on technology and defensive. This is consumer staples and technology. Um, so the first thing that you see, and this is what Lance and I started the year off with our concerns, that valuations are too high. And it's not just the NVIDIAs and the Googles of the world. It's everything just about. There's a little spots of green here, but you can see there's red in staples and utilities, real estate, energy, healthcare, pretty much financials across the board. But look at the price to earnings of Walmart. It's 44. Costco's at 52, right? So they're selling Nvidia at 37. They're selling Microsoft at 25, Google at 27, Amazon at 30, Meta at 28. To buy companies that are not necessarily growing that fast, at 44 for Walmart, 52 for Costco, Pepsi at 27, Coke at 25, McDonald's at 27.
Right. These are your classic cash cows, the companies that don't grow that fast, but they
that
just,
don't grow. They have
yeah.
earnings that are very tied to economic growth, that are somewhat very, decently predictable. The problem with looking at price to earnings is you're looking at last year. If I'm buying a company, if I'm buying a business, what I want to know is, I do want to know how it did last year, but I want to know is how's it going to do next year? Because that's what I'm buying. I'm buying the future. I'm not buying the past. So we can look at it two different ways. Instead of looking at backwards price to earnings, trailing 12 months, let's look at earnings for expected for the next 12 months. And just for context, the S&P 500 is around 21, 22. All of a sudden, Nvidia is cheap, cheaper than the market at 17. Google's at around the market level 22. Meta's cheap to the market. Microsoft is about at the market. Look at Walmart at 37. Costco, double the market. Um, these names, Coke, Procter Gamble at the market. Starbucks at 33. Um, so all of a sudden you're starting to see that they're buying what they think is value at very high valuations and shedding growth companies that are also starting to look like value companies. But now let's take this one step further. This is really important here. So now instead of using forward earning 1 year forward, we're looking at expected growth rates over the next 3 to 5 years. Now, I'll be the first to tell you that no one knows what's happening in 3 to 5 years, especially with the pace of AI. But these are based on estimates. So it's not as, look, we know the trailing earnings are what they are. That's happened. It's already happened. Forward 1 year is decently predictable. It can be off, but we have more insight into the next year. This extends it a little further. And what it does is it takes the forward PE and divides it by the growth rate. So how much, it basically sizes PE to to show you with the growth. Um, it's a
And Michael,
very
just to give, say it for folks. This is the price to earnings growth ratio, or what's called the PEG ratio, correct?
correct,
Okay.
correct. Basically factoring in growth into the equation because growth is what you're buying.
Yeah.
All of a sudden, so usually a PEG ratio 1 is considered the borderline between cheap and you start getting expensive above 2, but below 1 is cheap. And look what we got. Nvidia at 0.44, Microsoft at 1, Oracle, the beaten down stock is around 1, Broadcom at half, Amazon around 1, Meta around 1. Um, and what do we have up here? Walmart at 3, Costco at 4, Coke at 3, Procter Gamble at almost 5. Look at the utilities. They're not much better. Um, so you could say, okay, but NVIDIA's, I think the growth rate incorporated into NVIDIA is something around 50%. They're not growing 50%, you may say. That's fine. What if they only grow 25%, which is well below the 60% growth rate they just reported? It still has a PEG ratio below 1.
Hmm.
Then we got Walmart that whose earnings could not be more steadier around 7, 8, 9% at a PEG ratio of 3. So what's kind of really funny to me is that this whole value rotation is a rotation from value into very expensive stocks. And no one knows it because they're in this world now where we just look at ETF names and assume that because it's the value ETF, it holds value stocks.
Right.
And it's it's kind of become a farce. Because we're not as investors looking at individual names and looking at fundamentals. You're buying titles now. And because Nvidia's in the growth ETFs, it can't be value. It certainly is value at this point. And if you want to buy value, look at Nvidia is right up there. It's you don't see looking at this table, how many other companies do you see with a PEG ratio below 44 or even backing up with a price to forward earnings below 17? So, um, this kind of goes back to the market. I know it doesn't feel like it, but it's been calm. But underneath, you've had these massive rotations that have really distorted the market. And with that comes opportunity.
Hmm.
And that's why we have been shifting from quote unquote value to growth on the margin because we think that relationship, not think, we have technical gauges that tell us that relationship is overdone and we're due for a shift to growth stocks,
Yeah.
the
Okay. So
stocks
so
that
it seems.
fall into the growth stocks category. Now, what we don't know is the shift going to last? First of all, we don't know necessarily if the shift will occur just because we think it does. But if it occurs, is this like a 3 or 4 week event where growth is back in favor and we hear about the Magnificent Seven, and then value is kind of the predominant winner throughout the year? Could be. But right now, we're seeing signs that we're shifting back towards growth away from value. Um, and you've seen that the last couple of days, some of those names, Walmart got hit pretty hard. And even though it's a conservative stock to hold, it's just grossly overvalued at this point.
Okay. So potentially the market has been throwing the baby out with the bathwater when it comes to the growth stocks, right? You've had the hyperscalers hit over the past couple of months as capital has left them and gone into value. Definitely a lot of software stocks getting just clobbered like they're almost going out of business.
Mhm.
Um, so Michael, you're saying, okay, wouldn't surprise you. In fact, you're doing some positioning already for capital to start going back to the growth way, and your charts certainly make a compelling case. I want to ask you a question I've asked Lance in the past, which was when you guys were talking about rotation happening this year, I asked, could the markets, the general markets, the S&P, could that materially rise driven by the value sector versus the growth sector? Um, and I expressed some skepticism for that because the market weight of the growth sector is so huge, right? And Lance was like, "Yeah, I don't think the value sector alone can pull the S&P continuously higher." And maybe that's why things have been so range bound for so long, is as capital has been flowing into it's been flowing out of the big guys into the little guys, and I'm painting with a broad brush here. The markets just kind of stayed more or less the same. If you see a material rotation back into growth, does that make you begin to expect that the S&P may break out above the current range that it's been in, simply because an increase in those larger cap companies will have a much more disproportionate effect on the S&P?
Yeah, I mean it's just math,
Yeah,
right? It's really just a math equation. If if the stocks contributing the most to the S&P 500 go up, that should be good for the S&P 500. If the stocks that don't contribute nearly as much to the S&P 500 go up, but the biggest stocks go down, it's hard to expect the market to go materially higher. Now, over time, what happens is as the value stocks go up and growth goes down, those size of those boxes I was just showing start to shrink, and the size of the Walmarts and Costco's start to get bigger. So over time, I think it can start to have more of an impact. But I think it's going to be really hard for the market to rally without the magnificent, it's not even seven, it's really top 10 or 15 stocks. Um, and so that's why if we do get a rotation of growth, could be positive. Now, if growth and value start selling off in unison, which we have seen a little bit of that from time to time, then you could get the whole market coming down.
right.
But the other thing though is value has also supported the market while growth has gotten hit pretty hard, right? If you look at the returns on some of these tech stocks, they're down decently. And if I would have told people a year ago that the Microsofts, Google would be down, 10 to 20%, You'd say, oh, the market must have fallen 10, 20, 30%. That's not the case because the value was able to offset it. So, 450 stocks offset 50. Um, but, you really just have to think about it as a mathematical equation. And it's almost impossible for those 7 to 10 to 15 stocks to rally and the market really decline, and vice versa. If those 7 to 10 stocks are really doing poorly, I don't care what the rest are doing, it's going to be hard for it to have any kind of significant rally. But the
Hmm.
key is to move in and out, to figure out what's going to underperform and outperform.
Okay, so you've given some hints that you've been doing some trades on the margin. We're going to get to your trades in just a minute. Um, I just want to spend a tiny bit of time talking about the payroll data. So we got the latest payroll data this morning. It was kind of a shocker. I mean, it was the first real big downward shocker I think we've had in a while. Um, I think it was a Six Sigma miss to the downside. So it was minus 92,000 jobs um, for the past month. And the unemployment rate actually it was enough for the unemployment rate to tick up from 4.3 to 4.4%. Um, how material is this? Because, we've been skeptical of just the jobs data for a long time. I mean, for years. But even of late, uh, the job market just seems, from a whole bunch of other metrics, to be soft, right? We've sort of been trapped in this no hire, no fire economy. But you look at things like initial claims and stuff like that, you don't see, they look fine. You don't see signs of real distress in the jobs market here. This is maybe the first real data point in a while where people are like, okay, whoa, wait a minute, maybe there is some real trouble here. That said, we had, Snowmageddon in February where a lot of people couldn't go to work. So how much of this is something we should be worried about versus just the effect of extraneous things like, the week or two of
So,
folks not being able to get to work?
so I certainly pay a lot of attention to the BLS report, but I've been over the last few years focused more on ADP. It's just using real data.
Right.
It,
Yep.
it, it and it's been telling us the truth. The economy's growing, jobs at 30, 40,000 a month. That's that's what's been going on. It's muddling along. It's not good because the economy or the population growth in the working age is about 150,000 people. So there's an issue. We're only adding 30 to 50,000 jobs against a growing workforce.
Right.
That said, I hate the BLS December, January, February data. The seasonals are so extreme that it gets, and then you get the weather impacts, like you said, that you get remember the number last month was probably a, what, 3 or 4 sigma to the upside. Um, so you just get this volatility. But if you look at the two, they net out to be about 15,000 positive jobs a month. And I think that's kind of in the ballpark of what the economy is doing.
Okay. So
Not not
you're
good.
not too triggered or worried by this particular payrolls report. Obviously, you've got some concerns about just sort of the anemic job growth that we have in general, looking at ADP and other sources.
It kind of looks like that S&P 500 graph. It's arcing in the wrong direction, but it's not, there's
Right.
nothing there to tell you that the unemployment rate's going to 6% or we're going to start losing jobs every month. Um, but the hardest part with this is that personal consumption's at 2/3 of the economy. And when people feel um, unconfident about their job prospects or they see their neighbors get fired or their colleagues lose their job or they don't get a raise or a bonus, they spend less. So the question will be is, does this anemic job market, not bad, not good, feed into the consumer psyche?
Mhm.
And that's what we keep waiting to see. Retail sales today were minus 0.2%. They were 0% the month before. That's a bigger deal that no one's focusing on. And those are not real, those are not adjusted for inflation. So if you say inflation's running at, pick a number, 3%, that means retail sales are declining on a real basis.
It's just,
So
let me ask you a question I just asked David Rosenberg in the video that launched before this one. Um, we've got this K-shaped economy. The top leg of the K, the affluent folks, they punch way above their weight when it comes to spending. Something like the top 10% is responsible for 50% of consumer spending. And we've seen lots of reports over the past couple of years that the bottom leg of the K, which is the majority of people, is increasingly struggling. And the question I asked him was, I mean, I hate to ask it this way, but is the bottom leg of the K, is it kind of immaterial what happens to it as long as the top leg of the K continues its spending? And David pretty much said, yeah, sadly, I think that's the case. What really matters here is the spending of that top leg. And what really matters to them is the wealth effect of asset prices continuing to go up, i.e., the market. Meaning, if the market actually weakens, or in his case says even if it just goes flat for long enough, that's going to be the biggest thing to impact the economy because that top leg will then start to restrain its spending, and that's going to be really observable. Do you,
this is the S&P question you just asked me.
yeah,
What are the top 10 stocks doing versus the other 490?
right.
And it's the same answer. Uh, and what's interesting is there's always this old saying on Wall Street that the stock market predicts the economy, and it always peaks 6 to 9 months before GDP starts falling and you go into a recession, right? Well, maybe it's not that it's has such great foresight because we know it doesn't. It's that it's the wealth effect, right? Bernanke told us this. When he launched QE1, he said he's trying to help the financial markets, which improve spending ability for those people that own stocks. And he called it the wealth effect, the trickle down theory, the virtuous cycle, right? Everything's wonderful as stock prices go up. And I think David's right. If the stock market continues to tread sideways, doesn't even really have to go down. You're slowly starting on the margin, taking away the spending of those top 10, 20%, 15%, whatever it is. And at the same time, we know that the bottom 70, 80, whatever that is already struggling, right? Savings rates are really low. They're using a lot of credit cards. So there's not much room for them to expand other than wage growth, which has slowed down materially.
Mhm.
So, yeah, I think largely that this could be another instance where no one sees a recession, but the stock market stays flatline, stays in its rectangular box or starts heading lower, and that impacts the behavior of the top leg of the K.
Yeah, this goes to sort of like, you know, don't get too fixated on what you think the markets in the world should do. Just be fixated on what is. You'll have much better success. Like I hate the tenor of this conversation because it basically says it's rich people's world and the rest of us just live in it. But as an investor,
Oh,
what it's telling me is don't stress as much about the jobs data as perhaps even I have in the past, because it may not matter as much as it applies to the majority of Americans. What does matter more is where is the stock market going, because that's going to then impact the big numbers that impact us all in the long run.
yeah, but there are some big social impacts, and we could very easily see that in November with the election.
Sure. Well,
If the
again, that's what I said to David is it may be immaterial until it crosses some extreme threshold where the pitchforks and torches come out, and that's when
Right.
things change, either at the voting booth or hopefully never in the streets. Yeah.
Right. I mean, we're going to see the word affordability is going to be the Democrats' rallying cry for the next, what do we got, 7, 8 months? You're going
Right.
to hear that word more and more. And it's exactly, they're addressing that bottom leg of the K,
Yeah.
the 70, 80% that can't afford stuff. And now the price of gas is higher. So
Right. Well, the
it,
irony is
it
is that affordability was the rallying cry of the Republicans in the last election.
of course, yeah.
Yeah. All right. So in wrapping up here, Michael, trades. What trades have you guys made over the past week?
So we shifted the portfolio a little bit more from value to growth. And actually, I don't know if Lance talked about it, but it was either last Friday or Monday. I think it was last Friday. We true upped NVIDIA. So all accounts that are new and they weren't fully allocated, or accounts that had added cash, we bought NVIDIA up to the model weight. So it impacted maybe half of our clients to some degree or another.
Hmm.
We continued on that theme this week. We bought Salesforce and ServiceNow, CRM and Now. We added
Yeah.
1% of each. They're both
I-
software stocks.
right. Okay. And I think Lance mentioned those because I think he did them last Friday. That was entry positions, correct?
Well, we just did it this week.
Oh,
Uh,
okay.
we
Maybe you
did
said you were
it.
going. Maybe you said you were going
We
to.
were
But then,
thinking about it.
okay. But
Right.
those are entry positions, right? You're adding them.
1% each. We're dipping our
Okay.
toe in the water. We'd like to increase them, but you're still in a period where you're catching a falling knife, and that narrative is pretty damning. We don't necessarily believe it, but again, that's what's driving the price. To make room again, because we didn't want to increase our exposure, we want to keep it where it's at. If not, we actually decreased it very slightly. We sold Altria, we sold Visa um, outright. We also actually brought Microsoft up to model, which, because it had done poorly, meant that we added almost 1% of Microsoft to most accounts. So again, we shifted towards growth, towards technology, and away from perceived value.
Okay. And totally makes sense given everything you walked us through in
And
your slides.
and Altria is pretty interesting. That stock, we were forgetting the dividends, and they pay a hefty dividend. We bought it a few months ago. We were up 20% on that. That of all the stocks, that's a cash cow. That's just there is very little growth in that company, and it just spits out cash. So
Hmm.
that tells you how extreme this value trade has been. We bought that in Verizon the same day. They're both up roughly 20%.
Wow.
So they're really pushing stocks pretty far that don't really have that much growth
Hmm.
potential. Altria has very little, Verizon has more. But so that's, that phase of our rotation where we went to value, we're starting to peel back out of.
Yeah.
That's kind of
And
what
this
you're
is where
seeing.
your decades of expertise really come into play, where you can get to a point where you're like, look, we hope to trade like this, the trade would perform like this, but we know just historically it's gotten
Mhm.
ahead of its skis, time to lighten up.
Right. And when I'm looking at our list of trades here, the last 2 weeks, 3 weeks before, they're all sells. They're all small sells, but they're all profit taking in almost in all cases, value sector. Duke Energy, JP Morgan, Kinder Morgan, Altria, Verizon, Walmart, Berkshire, BlackRock. So, we're just slowly shifting, moving with those, not with we haven't really had to move with what's on the surface, but with what's underneath the surface. And back to what you were asking me, when are we going to move to reflect what's on the surface? And that's when the whole market, if it starts breaking down or breaking up, whatever may happen.
Okay. All right. Well, look, I want to end with just a very short rant here, and this is a positive one this week. Um, so, kind of thinking it in my mind as helping the helpers. So, we had the outbreak of the war in Iran, and I read something on X, and I'm going to do this from memory, but it was basically somebody, talking about the stresses that we all feel when a nation goes to war. And they were reflecting on something their grandmother had told them when they were young in life, which is, um, don't just be full of fear about the bad things that are happening. The grandmother said, "Hey, when something bad happens, what I like to do is I like to look at all of the people that rush to help. And that makes me feel better about kind of the human condition here. It gives me faith for the future. If something bad happens, you get a lot of Samaritans and altruists. You get out there and try to, basically help improve things. And my really the credit goes to my wife. But my wife and I did something this week that felt great. And it's sort of a helping the helpers type of thing, which is, we've moved to Reno last year. We're still discovering the city, and my wife found out about this organization called Liberty Dogs, which basically raises and trains dogs and then gives them to veterans who are returning from combat. And these, they're all labs, great personality, and they're very well trained, both in terms of normal commands, but also things that are sort of specific to the chronic issues that a lot of veterans have to deal with, the PTSD, the anxiety, the night terrors, that type of stuff. So anyways, you can sign up to be a foster family for one of these labs, puppies, and you basically raise it. And you raise it for like a year and a half. And then it goes off. Once it's all trained up, it gets paired with a veteran. They bring the veteran out for a couple of weeks. They get to meet the dog, learn all the commands and everything, and then they go home with the dog. It's a wonderful organization. And we've got two dogs of our own. We're not ready to sign up for a 18-month commitment or anything like that. And honestly, I don't know if I ever could do it, because it's personal failure, I'm sure, but I don't know if I could raise a puppy and then give it up. It'd be like giving up your child, right? But what my wife signed us up for was this kind of helper list. So the families that are fostering the puppies, they have life needs. They got to go out of town for a wedding or whatever, right? And so you can get yourself on a list to help them out and take their puppy while they're gone, right? So we had this wonderful little puppy for the past 3 days. So super fun. Nothing but joy for us, and we've got two older labs, and they learned to love her, and everybody had a great time playing together. But just karmically, just felt so good knowing that we were helping such a worthy organization, helping such worthy people. So, anyways, I just wanted to share that. I encourage everybody watching this to sort of think for a moment about like, well, what could I be doing at some point over the next day, week, month, whatever, to try to help some of the helpers in my community. Just coming fresh off it, I'm feeling that karmic high, and really would love to see that spread to more people. So anyways, I'll end the rant there unless you have anything you'd like to add to it, Michael.
Nope. Nope. That's really nice, Adam. I would take a puppy for a few days, but unless I'm gonna keep it, that's it. A few days
Yeah.
is enough.
Yeah, a few days is enough. And it is funny too, because like, every so often I get wistful and like, oh, we should get another puppy at some point. It does remind you, it is kind of like having a toddler. It is a lot of work. But the fun aspects way outweigh with the work stuff. So, all right, well, we'll wrap it up there. Folks, if you think one of the best ways to help the helper and yourself is to continue to watch and listen to Michael and his partner in crime, Lance Roberts, there on this channel every week to help guide your investment decisions. Let Michael know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. If you would like to get some help from a professional advisor in either maybe transitioning your portfolio a little bit more from value back to growth, given what Michael has told us about here, or just protecting against some of the risks that he's talked about here, highly recommend you get that counsel from a good professional financial advisor, and importantly, one that takes into account all the macro and market issues that Michael has been talking about here for us. If you've got to go and who's doing that for you, great. Stick with them. Don't mess with success. But if you don't, or you like a second opinion from one who meets those criteria, consider scheduling a consultation with one of the financial advisory firms that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. Perhaps you'd like to talk to Michael himself and Lance there at RAA. So to set up one of those free consultations, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. As mentioned, these are totally free. There's no commitments involved. It's just a service these firms offer to be as helpful as possible. Lastly, if you're watching this when this video launches, which would be Saturday morning, you now have less than 48 hours, if you haven't already, to buy your ticket for the Thoughtful Money Spring Online Conference at the lowest early bird price discount that we've been offering. I want as many people who go to the conference to get this lowest price as possible. So literally, folks, right now, pause this video and run, don't walk to thoughtfulmoney.com/conference and buy your ticket there, lock in that low price. If you are a premium subscriber to our Substack, check your email box. You've gotten a code from me that you can use to get an additional $50 off of that low early bird price that I mentioned. The conference itself is going to be Saturday, March 21st. Don't worry if you can't actually watch the event live that day, because everybody who buys a ticket will be sent replay videos of the full event, all the presentations, all the live Q&A, and you'll be sent that within hours of the conference's conclusion. Michael, I'm just going to rattle through it real quickly, but this is an unbelievable faculty, probably the best we've ever had, and it probably may be the most timely one of these we've ever done, given everything that's going on, not just in the markets, but obviously in the wider world, Iran being the prime example of that. But the conference will be kicked off by Lacey Hunt, and he'll be doing his usual graduate level keynote that he does for every one of our conference. We'll have first timers Ed Dowd, Michael Oliver, and journalist Matt Taibbi. We'll have Luke Roman and Brent Johnson. We'll have Judy Shelton. We'll have Daniel DiMartino Booth. We'll have Michael Howe. We'll have Darius Dale. We'll have Stephanie Pomboy. We'll have Lance Roberts. We'll have Lynn Alden. We'll have Rick Rule. We'll have Darius Dale. We'll have Melody Wright. We'll have Andy Scheckman. Man, I think there's one or two others I'm forgetting, but it's a massive murderer's row. It's going to be really our best conference ever, folks. So again, if you haven't bought your ticket yet, go to thoughtfulmoney.com/conference. And with all that being said, Michael, as I say every time you're on, we should have you on more often. That Lance guy should go on vacation more often. It's always wonderful to have you on here, to have the brain trust of the RIA organization here to talk to us. So thanks so much, and I'll give you the last parting words if you've got any counsel for folks watching here.
No, just first of all, thank you for your kind words. And look, we're in volatile times, and this is when it's most important to have your rules and not let your gut get the best of you. So, or the voice in your head. The voice in your head's even worse than your gut. So, I know it can be scary what's going on, but just because it's scary doesn't mean the market's going to fall 30%. But, you just follow your rules. And if you do that, you will get out of the market when you need to get out of the market. You'll stay in the market when you think you should get out of the market. That's it. That's all I got.
All right. Well, very wise words. All right, my friend. Thanks so much. Great having you on this week. Hope we have you back on again soon. And everybody else, thanks so much for watching.
Bye-bye.
In the next handful of months between now and the end of the year, silver is likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. To be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher price of gold. Well, right now, silver's 1.12%. Decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds. 100 to 200 would not surprise me.
Central bank and sovereign demand for silver is rising, supporting higher prices, while COMEX and LBMA delivery activity and ETF redemptions indicate big players are taking physical possession. Analysts view silver as undervalued versus gold and expect a breakout, targeting $60 to $70 by year-end, with potential $100 to $200 plus in a full monetary or credit stress scenario. Risks include unverified accumulation data and uncertain timing of delivery squeezes. Michael Oliver, CEO and founder of Momentum Structural Analysis, argues that measuring silver in dollar terms is almost meaningless. He sees silver potentially reaching $100 to $200 but takes it in stages, personally favoring silver miners over gold. Historically, silver has averaged around 2% of gold's price and even hit 3 to 3.5% in past bull markets, while today it sits at just 1.12%. With silver already up 42% this year versus gold's 37%, technical charts suggest an imminent breakout. Several well-known bullion commentators and dealers' voices like Andy, Bill Holter and Mike Maloney argue the market is now driven by huge physical demand, tightening supply and central bank sovereign buying, conditions that can push silver rapidly higher and make a $60 to $70 year-end print plausible. They point to record COMEX delivery interest, growing central bank interest in silver, and China's physical buying as the catalyst for an imminent breakout. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
I think it's really relevant. Yeah, as I said, so many years have passed that the real value of the money unit that we're measuring by, the dollar in this case, or you could do it with euros or anything else, is just meaningless. The decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds, 100 to 200, would not surprise me. But we're taking it in segments. And my own personal investments, which we show at the end of each report, the disclaimer, are heavily in silver miners as opposed to gold. Okay, though gold is the mama, it's going up. Silver has both outperformed and underperformed gold on a routine basis over the decades. And if you go back 50 years and look at what is the highest relationship of silver to gold in any one of those given years, and plot it. We have a graph we put in the latest report. 2%, meaning divide an ounce of silver into gold. Silver was 2% of the value of gold in 20 of those 50 years. So it's not absurdly, to be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher the price of gold. Well, right now, silver's 1.12%. Okay, still dirt cheap. It got under 1% recently, which is historically very, very low level. When you see that, buy it. But when that spread turns up, and it's been turning up sharply, well, just for example, this year, people don't realize this. Silver's up 42% on the year today. Gold's up 37%. And yet most people still think silver's lagging. It's not. It's catching up to gold. And there are certain technical levels not far above where we're trading right now that if silver spread versus gold can reach those levels, the spread chart and the momentum of the spread chart, which is what we look at, both technical metrics, have very clear pending triple top breakouts, meaning levels that they've stopped twice before. And if you punch up through that, these levels go back several years, by the way, you're breaking out big time. So if you looked at these charts, these spread relationship charts, and treated it as a price chart, you'd say, oh boy, you break through that and I'm going to blow the cork off this thing. The spread is about to do that, I think. And when it does, I think in the next handful of months between now and the end of the year, silver's likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. Well, that's a huge move because we're talking almost doubling the current relative value of silver to gold very rapidly and going up to that, quote, normal 2% level. Because we're, like I said, 1.12% right now. So anyway, I think there's a huge explosive potential in silver, coincident with the rise in gold, but advancing more so. And so that's why my personal emphasis is in the silver aspect of the monetary metals.
Michael Oliver warns that relying too much on fundamentals can mislead investors about timing, like the analysts in The Big Short who were early but not immediately proven right. In 2025, silver has risen 45% so far, hitting about $42 by mid-September. Rising industrial demand for EVs and solar panels, continuous supply shortages of about 800 million ounces since 2021, and growing central bank and investor accumulation through physical holdings and ETFs are the main drivers of its climb. Although supply is static and demand is dominated by China, silver's industrial role is expanding. Nevertheless, until prices compel attention, markets frequently overlook such truths. More significantly, silver has historically been used in conjunction with gold as money. Confidence will crumble as inflation reduces purchasing power and people lose faith in institutions, currencies, and central banks. This transition from optimism to anxiety could be brought on by a declining stock market. Major systemic changes, like the Federal Reserve's demise or income tax reform, are made possible under that setting. That unrest will help silver as an industrial metal and as currency. Let's shift our attention towards the interview.
Well, first off, I don't look at it that much, and I try not to, okay, because I don't want to be distorted by a notion of fundamentals. Why? Because quite often fundamentals, even if they're true, even if your assumptions are correct, that doesn't tell you about the timing. Mm-hmm. You could be right and not be right in terms of price reaction for 2 years, okay? You know, do you remember the movie The Big Short?
Yeah.
The guy, these 3 or 4 analysts around the country, different guys, didn't know each other, all came up with the same conclusion. There's going to be a mortgage crisis. There's no way around it. They pounded the table, okay? That was 2005, 2006. And it wasn't until late 2007 that the stock market finally topped. And it wasn't until 2008 finally that they said, I was right. So you get the point, fundamentals. Mm-hmm. Okay. Silver does have certain unique, we know the industrial aspect. It used to be, you take a picture, that silver was a key factor in photography. Now it's a key component of solar cells. And it's also, as I understand, essential in the big AI explosion because silver is such a good conductor. Okay, well, the numbers that I've seen, and I don't know the validity, they probably are because I see them from too many places, of supply demand on the industrial side is very tight. The annual production of silver is not increasing, it's plateaued, and demand is continually increasing. And by the way, China is one of the chief demanders of silver because they're like 80-90% of global solar production, solar panels, which silver is essential. So anyway, that could become a factor where, let's say we cross 50 and CNBC needs an excuse to explain it. Okay. And that's a good excuse. Oh, well, the industrial demand. Well, that's true now, but sometimes it takes a while for that reality to finally be used as the excuse. The bigger issue is silver's money, just like gold. A lot of people like to treat it as not monetary metal, but as history shows, it has been. In fact, the U.S. has had silver as official money, too. So I think the crisis we're facing in global assets, global suffering, economic suffering, not just U.S., is going to be such that you're going to get a lot of things thrown up in the air in doubt, where you doubt the validity of a certain institution to provide what it's supposed to provide, like the central bank. You suddenly realize the value of the stuff in your wallet is decaying so rapidly it's ridiculous. As I said, your grandfather, father, and you, house cost, loaf of bread price when I was a kid, it's 52 card pickup. And I think the stock market will be a big key in that. Why? Because right now, if you look at, let's say, the average guy who's got a retirement account, maybe it's through state government pension fund or whatever, if he looks at it nominally and it's been going up because if it reflects the S&P, then it's been going up. Okay. Not a lot, by the way, over the last year, but, single-digit percent still. It's the only thing he's got to smile at. Everything else in his life is questionable. Cost of things are going up, et cetera, et cetera. And when that goes down, then it's, oh, hell, what's good? All you need then is some layoffs, et cetera, et cetera. And suddenly the average guy, instead of a sense of expectation, is a sense of doubt. And that creates fear. And when you create fear, the tone of markets change. And that's when institutions can get overthrown, ousted, abolished. And so it wouldn't surprise me that in a year or two there's no Federal Reserve. If the economy gets bad enough, which I suspect it will, there may not be any income tax simply because it doesn't function. They go to a sales tax, etc. All kinds of things can change in big ways. I think that's the kind of situation we're facing now.
As trust in fiat currencies and institutions declines, there is a chance for sharp movements. How much higher may silver's price realistically rise in the upcoming years if it even recovers to 2 to 3% of gold's value? Will a decline in trust in central banks hasten the adoption of silver as a monetary asset and an industrial necessity? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
I think we'll see new highs in the next 12 months. And I think we'll retest the highs in the next 6 months. So retesting meaning 50 in the next 6, and then breaking out to new highs in the next 12 months. I could be wrong on the timing, but it certainly seems like that's a very intriguing timeline to follow because of the volume we're seeing of purchases post days of declines. We're seeing clearly the outperformance of silver even when gold is falling, and the reaction that even technical analysts that tend to push these movements from a momentum standpoint are beginning to see the probably greatest cup and handle we've seen in history that is still not, have not ended. We still need to see the other side of that handle really break out.
The silver will retest its previous high of around $50 within the next 6 months and likely break out to new record highs within a year. While the exact timing could vary, the outlook is supported by strong buying activity on market dips, silver's resilience compared to gold, and technical patterns, particularly what may be the largest cup and handle formation ever observed, that suggests a powerful breakout is still ahead. Tavi Costa is a macro investor and portfolio manager at Crescat Capital, best known for his deep research on commodities, precious metals, and global macro trends. The classic cup and handle pattern starts with a massive price surge, like what happened in silver during the 1970s, followed by a peak in the 1980s and then a long period of decline and loss of confidence that lasted about 20 years. That long downturn marked the bottom of the market, and by the early 2000s, silver began another cycle, eventually retesting its previous highs. Each time prices return to those old highs, selling pressure often increases because investors fear a repeat of the past. However, the recent decline in silver wasn't as deep as the crash of the 1980s, and the industry has recovered more steadily this time. Now, silver is once again pushing toward its historic $50 peak, and with so much momentum behind it, many believe a breakout is coming. In markets, there's a saying that there's no such thing as triple tops, suggesting silver won't stall out again, but instead move higher once it clears resistance. For investors, the takeaway is clear: prepare for the possibility of much higher silver prices, but the broader setup strongly favors silver's long-term upside. As we present clips from the video, please like this video, subscribe to our channel, and turn on the notification bell to stay instantly notified every time we upload a new video. Thanks for the support, and enjoy the video.
If you think of how a cup and handle is formed, it initiates with a large movement that is usually unprecedented, which happened in the 70s, and then peaked in the 80s. And then you have this complete loss of faith and a peak of a bubble. And that goes on for a long time, 20 years or so, of which was the case until the late 90s. And after we saw that, that was the very bottom of that market. So we went all the way up and created the beginning of another cycle, which was the early 2000s, until we retested the highs of the prior bubble. And so investors look at those two things and say, well, that looks like that same issue we had in the past. And so the selling becomes more pronounced at those levels. And it's normal to see that type of pressure creating another long-term decline. The difference is that this decline wasn't, although it was very difficult for those invested in this industry. I wasn't involved with the industry personally, but I clearly that decline really shaped the industry in a big way as well. But it wasn't as deep and steep as we saw in the 80s. So that decline, although marked, in a huge way, the history of silver, it was definitely, much easier to stomach relative to the 80s. And so now, we're seeing another movement to push again to that same level that we saw the peak of the bubble in prior times. The thing is, there's so much energy behind this to see the price breaking out. There's a joke that we say in markets, there's no such thing as triple tops. And there we have it, approaching a triple top. There's going to be maybe a moment where we hit that 50, and nobody knows if that's going to be the case. But there's a very high likelihood that we may hit the 50 and people will say, well, that might be it. We might hit a peak here. I don't think that will be the case because cup and handles break out. And so we may see a short-term movement. This is why I said 6 months to get to 50, 12 months to break it through it. But I do think, regardless of the timing of how this whole thing will resolve, I think the resolution is we're going to see much higher prices. So if you're investing in the space and you have that view, you can apply that in markets. Look at if you're running a mining company, you can see this. All right, well, there's a clear path that we may see a break of silver prices. What is my biggest risk here? One, that I'm wrong. You could always be wrong. But two, how do I secure my margin? Because that's the biggest thing. That's your biggest treasury. So this is why I'm urging people in the space to say, protect your margin, because your biggest risk right now is energy. It's not the stock market, it's energy. And in some cases, investors may have issues with maybe labor costs and others. And so it depends on the structure of your costs. But usually energy is about 30% of your cost, particularly coming from open pit projects. And so, yeah, that's the way I'm envisioning this whole thing. And as an investor, if you are in that side of the market, then, act accordingly. Think about companies that will be in a great position if prices reach those levels and plan for that, really try to plan for it. And yeah, that's the way I invest. That's the way I do my things. And, if things change and the plans change and there's another pandemic or something along those lines come and we have a major change in markets, sure, I'm allowed to change my views. But having a plan is important. And so that's how I'm trying to approach this.
Tavi Costa explains that gold has led precious metals and hard assets for a while, but markets often rotate leadership between commodities. Although gold functions more like a currency, it has acted as a commodity and signaled the start of a long-term bull cycle in the sector. Recently, however, other metals and related assets have begun outperforming gold. Tavi relates this situation to April 21st. Gold has moved mostly sideways, while the TSX Venture, heavily weighted toward precious metals, rose over 30%, and silver gained double digits. This shows investors are becoming more comfortable with gold and are now moving further along the risk curve, seeking higher returns in less liquid assets like silver and mining stocks. The trend suggests we're entering a phase where other metals catch up to and potentially outperform gold. Moreover, Tavi exposes that we're in what could be called a golden age of mining, as profit margins are exceptionally strong with gold and silver prices far above production costs. However, this may not last forever, so miners should hedge energy costs to lock in profitability. At the same time, the industry faces a major challenge. Reserves are being depleted, few new discoveries are coming online, and exploration budgets remain low, leaving most major miners with very limited replacement reserves. Now, let's just dive into the interview.
Yeah, I do. I think that would be a normal behavior of the metal. We've had, gold really leading the pack of precious metals and hard assets for some time now here, especially in the commodity space. And I think investors that understand the commodities, sector very well will appreciate the fact that there is a rotational dynamic that usually happens where a commodity will take the lead versus another at certain times. And I'm not here to claim that gold is necessarily a commodity. I do view it as a currency, but it acts as a commodity in that case. And I think gold has been signaling that for some time now, that we've seen finally the beginning of a long-term cycle in this whole industry. And we're now what seems to be the beginning of other metals and other derivatives of the gold-related trade or investment starting to outperform gold itself. If you look at the gold price all the way back to just April 21st, when right after the whole situation with tariffs and so forth, the Liberation Days, which happened in the 7th, but gold really peaked in the 21st. We've seen gold basically go sideways. And at the same time, we saw the TSX Venture, which marks a lot of especially if you look into the subgroup of precious metals, that whole space was up about 30+% during the same time that gold was basically flat. So, certainly there has been an exercise that I called of acceptance of risk occurring across investors that are looking for the next thing after gold. That doesn't mean gold is going to go away as a trade, but it means that investors are so comfortable with the gold idea that they're starting to go down or go up on the risk curve and go down on the liquidity curve in order to hopefully capture more returns. And I do think that's going to be the case. And so, I'm paying attention to that because silver has also outperformed gold since, silver's up double digits since gold has been basically flat and down, in fact, since April 21st. So all these things are really interesting. And I think that's the beginning of other metals catching up to gold prices finally. We're seeing what I like to call the golden age of mining, mostly because the margins of these companies are just outstanding. And you can see that in many ways, especially looking at the gold to oil ratio, the silver to oil ratio, and obviously looking at the median cost to produce gold today or silver is drastically lower than the actual price of those commodities or those metals. And that's probably, I don't know if that's going to be the case for the long haul, because I do think energy cost is way cheaper than has ever been relative to metals. And so if you're a producer, you definitely want to be making decisions to hedge energy costs if that's a big issue for you as a miner. I think that's a very important point to hopefully miners will take that strategy as an approach to secure some of those margins over the long haul. We certainly have done that with our own mine, San Cristobal, which is the 4th largest silver mine in the world. We have instructed them to, and they have done it, basically hedge their energy costs for the 3 years out. And I do think that's, eventually we all know so we were talking about political constraints. Let's talk about industry-wide constraints. One of the largest ones certainly is what we have in terms of the depletion of reserves and no new discoveries coming online. If you think about how many development stories are going to be coming online to become producing assets, it's very small. And also, if you look at the exploration budget across most of the major companies and how much they have found in terms of added ounces, and it's also very small. So the replacement reserve is actually very low today across most of the majors.
Silver appears to be on the verge of a historic breakout, supported by strong technical patterns, resilient fundamentals, and a shift in investor appetite from gold toward higher risk, higher reward assets. Mining companies stand to benefit enormously, but only if they manage costs and secure future reserves. For investors, the setup points to a rare opportunity in both silver and quality miners, though timing and risk management remain key. Do you think silver will finally break above its $50 resistance this cycle, or will history repeat with another stall? How should mining companies balance short-term profitability with the urgent need to replace dwindling reserves? Please leave a remark in the section below with your ideas. Please remember to subscribe to receive updates, and if you find this helpful content, kindly give it a thumbs up. We are grateful that you joined us on this journey.
So you're seeing retail catching the wave, yeah, which is driven by governments buying gold, right? So they have to get out of the way of the price. The price is running. Now silver's running. Yeah. So that is what's going on. The question is, where's it going? And when I look, well, I mean, when is the situation with America, which is effectively saying it's on the warpath?
Right.
Yeah. I mean, China's saying, yeah, we're just growing, we get bigger and more powerful. We've got 4 times more people than you, and give us 10 years, we'll have as much money. So we'll have 4 times as much money as you. We're the superpower now. And America's going, hold on a minute. No, we're in charge here. And stop that. Stop that getting richer at our expense. No, we see you now. We know what you're doing. You're going to stop that.
Retail investors are now riding the momentum in silver, fueled by governments accumulating gold and pushing prices higher. With the market moving fast, the real question is where it's headed next. On the global stage, the US is signaling aggression as it seeks to maintain dominance, while China, with its massive population and rapid economic growth, is positioning itself to rival America within the next decade. The US sees this rise as a threat and is determined to halt China's advance, setting the stage for escalating tensions that are further driving demand for precious metals. Clem Chambers is a well-known financial commentator, author, and entrepreneur. He highlights that gold is surging because governments view it as the currency of war, a hard asset essential for defense and global power, beyond the reach of paper money or manipulation. With the US and China in open rivalry, central banks, especially China's, are buying heavily, driving prices higher. Silver, on the other hand, has always been everyday money. So as gold becomes too expensive, retail investors are piling into silver as the affordable alternative. Together, this creates a chain reaction where governments fuel gold, retail fuels silver, and institutions can't stop the momentum. For additional information, view the video. Please subscribe and like the material if you enjoy it, to receive the latest updates.
Well, hold on a minute. Gold's a bit expensive now. What? $3,500 an ounce, that tiny little fleck of and silver, I can buy a sack of it. I can buy a load of old quarters from 1935. And by the way, if the world did end, I can go to my neighbor and say, see that chicken? I've got a silver quarter for you. I'll buy it. You can't do it with gold coin, can you? So anyway, the old currencies apply, but silver, see, gold back in the day was not money, it was currency. You have a few gold coins, you put them under the floorboards. It's not everyday money. You don't walk around with it. Now, if you think about gold, silver, copper, gold is for your cash, your wealth, yeah, or whatever counted for banking. Actually put it in a bank, literally bury it underground in the corner of your house. That's how they used to do it. Silver, now that is purse money, that's wallet money. You carry that in a little sack which you tie to your pants. Okay, right. So you don't really lose it because it's in a purse. You might bury the purse if you're having a problem. It might split. It might all fall out. That would be a pain. But you put the copper in your pocket. That is pocket money. So you've got pot money, purse money, and you've got pocket money, right? Which is why if you go treasure hunting, you will find infinite quantities of copper because it was in the pocket and easily lost.
Right.
Yeah. So that is the hierarchy of metals. Yeah. So gold is for cashing. Silver is for high-ish value transactions. Yeah. So that's why it's retail. That's another reason it's retail. So anyway, a retail looks in and goes, look at that gold go. Oh, I'll buy silver. And that's what you're seeing now.
Right.
So you're seeing retail catching the wave, yeah, which is driven by governments buying gold. In the old days, your investment banks would go, "Hey, gold's going on a run. We're short that. We're short that. We're short that. Oh yeah, we manipulate the price." And retail will go, "Oh no, I'm losing money. I'll sell. Oh, I'll take it
Right.
back. I'll take it back." And you
Right.
can
Right.
and the institutions can do that with retail because retail is there's always the frothy part of retail that is easily manipulated, but they
Right.
can't do that to government. That's playing, that's wrestling Godzilla. You are going to lose, right? So they have to get out of the way of the price. The price is running. Now silver's running. Yeah. So that is what's going on. The question is, where's it going? And when I look, well, I mean, when is the situation with America, which is effectively saying it's on the warpath?
Right.
Yeah. I mean, China's saying, yeah, we're just growing, we get bigger and more powerful. We've got 4 times more people than you, and give us 10 years, we'll have as much money. So we'll have 4 times as much money as you. We're the superpower now. And America's going, hold on a minute. No, we're in charge here. And stop that. Stop that getting richer at our expense. No, we see you now. We know what you're doing. You're going to stop that. Well,
Clem Chambers demonstrates that China under Xi has shifted from cooperation to confrontation, reviving Maoist ideas, discouraging Western influence, and asserting power over Taiwan. This has fractured global supply chains, turning critical resources like rare earths and cobalt into weapons of leverage. The U.S. is responding by rearming and rebuilding industries like shipbuilding, which are essential for military strength. Strategic reserves of gold, silver, and critical materials are becoming vital as global trade routes grow more fragile and politicized. Clem emphasizes that this dynamic is reshaping geopolitics. America is pressuring Europe to rearm while also courting India to counterbalance China. Russia, though armed with nuclear weapons, lacks the economic weight to compete. China, however, is a true rival, with far more financial resources and technological capacity. The global stage is being redrawn into blocks, and for ordinary people and markets, the consequences mean heightened risks, disrupted trade, and the urgent need to secure assets in times of escalating conflict. Let's redirect our attention towards the interview.
Xi came in to China and brought back Maoism, which is not good. He said to these children, stop playing computer games, start getting fit, stop learning English. Hey, Taiwan, we're coming for you.
Right.
Well, that's what kind of started the ball rolling. Yeah. Now, their predecessors were much more, we'll be your friends. We'll make your plastic junk. We'll make money. And we'll all be very civilized and nice. And, we can all be friends. But Xi has taken a China exceptionalist point of view in the same way as America takes an American exceptionalist point of view.
Right.
And in fact, the world needs to be more like the Europeans who up until recently have been quite laid back. We can get on with you. Yeah, build a pipeline. Yeah, let's all do business. Yeah, let's all be friends. Well, that polarity means that all these global supply chains are now fractured. Yeah.
Right.
So you can't actually rely on your cobalt flow anymore or your rare earths anymore. And that's the base of your economic pyramid. And whereas before they were commodities and they just got loaded up to ships and sent to wherever they needed to be, and everybody was, relatively reasonable with each other. Now it's like, oh no, you can't have your rare earth. No. We've weaponized it. No. See how far you're going to get with your business without our rare earth. Oh, cobalt. No. So now countries basically have to build up strategic reserves of all sorts of critical things. And
Right.
silver's just as good. You start by going, oh, the only thing we need is gold, because gold, that's bullets, and we can buy everything we want with gold. And then you go, actually, maybe we can't. Maybe we won't be able to buy it all. Maybe we won't, if they're shipping it, and they say, no, if a ship goes there, we're going to sink it. I mean, what's been going on with the Houthis? They've been firing at ships. The thing that happened also, that is, I had to check up to see whether it happened, and it actually happened. Trump came out and said, if you've got a Chinese ship, and you land containers, we're going to bill you. We're going to bill you 2% of the value of those containers when you land. So if you're a container ship built in China, that's a $7 million bill just to pull up at the port.
Wow.
Yeah. And that's so that people buy American ships, not that America makes many ships just yet, so that the ship industry in America will take off again. And why do they want shipbuilding in America? Well, if you can't build ships, you can't build battleships, can you?
Mm,
Yeah, you can't build all those Liberty ships that were built in the Second World War to ferry all that important equipment around the world as you're fighting World War III. Oh,
right.
whoops, I can't build ships. Oh, well, actually, maybe we'll build a few shipbuilding. Oh, I can't build ships because I haven't got any iron. Oh, still, no, and I haven't got any I've got no
Yeah.
rare earths. I can't build any planes. Yeah. So that is what's driving all of this. It's basically America rearming.
Wow.
And yeah, exactly. And it's not good. It's like, okay, you could say they have to, they need to, they must. Okay, I'm not going to argue with that. But what that actually means in reality to people like us and to the markets and to the world economy and what is the denouement on that? Normally, these things don't suddenly heal themselves and everyone's friends. That is dramatic, absolutely dramatic. And that drumbeat, I mean, when they had that speech in Europe, it was like, oh no. And then you go, well, I'm just being paranoid. I'm old and I'm paranoid. Oh no, they've done something else. And every dot on the map, it only makes sense when you see it as America rearming.
Right.
And they've told Europe to rearm, and Europe is rearming. Well, that's not good. I mean, okay, forget it. Maybe it's great. I mean, maybe I'll be, old enough. I won't care that there's World War III started. But maybe I'll make so much money. I'll be in Chile. I'm drinking red wine, crying, but I'll be far away. But nonetheless, it's not. I can't change that. The only thing I can do is look at it and see where there's real returns to be made to
Right.
secure myself and my family. And that's how I look at it. It's, I can't, maybe it's necessary to have World War III. It's nothing to do with me. I can't affect that in any shape or form. But there you are. There is that drumbeat. And they might stop. After all, somebody wants a Nobel Prize. Maybe China is too fragile to get into this Cold War conflict. Maybe it's, Russia versus America all over again. Maybe it
Right.
isn't, whatever. But if you don't realize what appears to be going on, you don't track it, and you don't. I mean, something that is. I was relieved a few weeks ago. Trump was getting angry at India, at Modi.
Yeah, I heard about that.
Yeah, but you realize the moment America starts sucking up to India, that is very, very bad, because in a global conflict, it's China, India, Russia, and America and Europe, right? India is a major player. Now they historically go, nothing to do with us. No, nothing to do with us.
Right.
Nothing to do with us. But if America is really accelerating, it has to make India either neutral or their friend, because then it's China and Russia. Well, Russia's nothing. Everybody's worried about Russia. Russia's 150 million people with no money. Right? China is 1 billion with all the tech that we love. I mean,
Wow.
forget Russia.
Yeah.
Russia is, not a thing really. I mean, it can nuke everybody. That's the thing it's got. But you take away its nuclear, what has it got? It's got no money. It's got hardly anybody. Yeah, 150 million people versus 500 million people, $7 million GDP versus a $35,000 GDP per head. It's like
Wow.
1/18th of the economic power of Europe,
Yeah, it's a
without
big
even
difference.
factoring America in there.
Yeah.
But China's a different matter. China's got more money, literally more cash. In dollar terms, it has got twice as much cash in dollar terms in America.
Wow.
So if you counted up, if you stacked up all its yuan, and you said that's that much of dollars, and you stacked up all the American dollars in existence out there in circulation, it's got twice as much. Yeah, you fly into Shanghai at the airport, and you fly into JFK, and you think, JFK versus Shanghai Airport in a battle. There's only one winner there.
In short, the world is entering a new era where gold and silver are not just investments but lifelines in a fractured global order. As nations rearm and tensions rise, precious metals are gaining renewed importance both for governments seeking power and individuals seeking protection. The momentum in these markets reflects not just financial trends but deep geopolitical shifts that will shape the decade ahead. How long can central bank demand continue driving gold and silver higher before retail investors face a major correction? Could rising geopolitical tensions accelerate a shift toward a new monetary system backed by precious metals? We'd love to hear your thoughts, so share your comments below. Don't forget to subscribe for more content and hit the like button if you found this video valuable. Thanks for being part of this journey with us.